Okay, so if you've been tracking the whole AI boom, you already know the physical hardware, the actual infrastructure, is just as crucial as the software itself. Today, we're unpacking the financial reality of Coherent Corp. They are literally right at the heart of this massive hardware buildout. Based on some really deep financial data and a recent analysis from mispriced assets, we're going to explore if the broader market just completely misunderstood this AI gem. Let's jump right into this explainer and look at the numbers, the business segments, and their current strategic moves.
So we're starting off with a massive puzzle today. Picture this. You've got a company that is actively building the AI data center revolution. They report really robust earnings, and then, boom, the stock just plunges. Right after their fourth quarter fiscal 2025 report, Coherent stock took a nosedive from around $114 straight down to roughly $89. I mean, that's a brutal 20% haircut in a single day. The question is, why? Are we looking at a fundamental breakdown of their core business, or, was this just a temporary freakout by momentum traders?
The cognitive dissonance on this one is just striking. It's a total head-scratcher. Look at this. On one hand, Coherent surged its full-year revenue by an impressive 23.4%, hitting a massive $5.8 billion. But on the other hand, the stock takes a 20% dive. According to our sources, this drop was largely driven by these Tiger Cub-style managers, basically short-term momentum chasers who totally panicked over a slight quarter-over-quarter deceleration in just one segment. But honestly, reacting to that minor blip, that means missing the massive structural growth happening right beneath the surface.
To figure this out, we actually have to look past the officially reported GAAP net income. A headline net income of just $49 million? Yeah, that sounds incredibly weak for a $5.8 billion company. But guys, that number is basically a classic accounting illusion. It's being weighed down by a staggering $554 million in non-cash depreciation and amortization charges. Because Coherent is a hardware-heavy company that's fresh off a major merger, these paper charges just make their official profit look microscopic compared to the actual, real cash they are generating.
Okay, so the absolute crucial metric you need to focus on here is 12.84x. This is their earnings quality ratio. And man, it's an absolute powerhouse. Check this out. For every single dollar of reported earnings, Coherent generates $12.84 in actual operating cash flow. So while the accountants are sitting there saying they made $49 million, the business actually pulled in $634 million in cold, hard operating cash flow. And as we know, in business, cash is reality. And Coherent, they are printing it.
And all of this underlying strength just brilliantly proves that their fundamental health is incredibly sturdy. When you run them through the rigorous Piotrowski F-score, which is that classic 9-point test for operating efficiency, Coherent easily passes 7 out of 9 metrics. They've got positive net income, robust cash-backed earnings, gross margins climbing to 35.2% for the year, and improving asset turnover. The engine of this company isn't just running, it's getting significantly more efficient.
Now let's break down the actual business segments, because what we have here is truly a tale of two distinct stories. The data center and communications segment, it's experiencing an absolute boom, with full-year revenue jumping 61%. That's the AI tailwind in full effect, right there. Now contrasted against that is their industrial laser segment, which saw a 15% year-over-year slump in Q4. But wait, our source analysis heavily stresses that this weakness is entirely driven by macroeconomic softness. There are absolutely no structural issues, no lost customers. It's just a cyclical lull that's kind of masking the explosive growth happening over in their AI unit.
Well, if that industrial slump gives you pause, just consider the perspective of legendary investor Stan Druckenmiller. He famously operates by this really strict rule. If something needs to be hedged, you shouldn't have a position in it. Simple as that. And according to the data, Druckenmiller holds roughly 2.22 million unhedged shares of Coherent. That is about 7% of his entire family office portfolio. That level of institutional conviction just completely ignores this kind of short-term market noise.
So to really grasp that bullish institutional confidence, we have to look at what Coherent actually builds. We're talking 800G and 1.6T transceivers. I want you to think of these as the essential high-speed optical plumbing of the AI revolution. When these vast clusters of AI chips need to communicate to train those complex models, they have to transfer mind-boggling amounts of data instantly. Without Coherent's optical technology allowing that data to flow seamlessly, the entire AI revolution literally bottlenecks.
And their management has laid out this incredibly clear, multi-year runway with continuous strategic ramps. In Q4 of fiscal 25, they started shipping those vital 1.6 terabit AI-centric transceivers. Near term, they're smartly divesting their low-growth aerospace and defense unit for a cool $400 million. And looking ahead to the second half of fiscal 2026, a major multi-year partnership with Apple ramps up to supply advanced laser components for iPhones and iPads. I mean, they are just launching cutting-edge products across the board. Actually, let's talk about that defense divestiture for a second, because it isn't just about shedding dead weight. It's an absolute strategic masterstroke for their balance sheet. By selling off that low-growth unit, they get $400 million in cash. They then take those proceeds and immediately wipe out their high-interest 6% debt. And by killing that debt, Coherent instantly saves roughly $24 million in annual interest expenses. That is pure profit falling directly to the bottom line, boosting their earnings per share without having to sell a single extra product. It's brilliant.
As they execute all these steps, their underlying profitability is expanding so rapidly. Their non-GAAP gross margin hit 38.1% in Q4. That's up 220 basis points year over year, and management actually noted it would have been even higher if not for some temporary foreign exchange headwinds. This shows immense operating leverage. As their revenues scale, a much larger percentage of every dollar drops straight to the bottom line. Management is confidently targeting long-term gross margins above 40% now, which is a huge catalyst for future profit.
And because of these combined catalysts, the AI product ramps, the debt reduction, the expanding margins, Wall Street analysts are forecasting an absolute explosion in earnings per share. Back in fiscal 2025, they sat in negative GAAP territory at minus 52 cents. But estimates have them leaping up to $5.48 in fiscal 2026 and then surging all the way to $7.63 by 2027. And honestly, some analysts think even these targets might be conservative. This is a company hitting a major inflection point where revenue translates into exponential profit.
That kind of incredible growth profile brings to mind this classic Peter Lynch quote from our sources. The key to making money in stocks is to not get scared out of them. When those short-term traders dumped Coherent after earnings, driving the price down to $89, they were reacting to minor fluctuations. They were getting scared out of the stock. But if you step back and look at the fundamental realities we've just covered, the long-term thesis hasn't been broken at all. Actually, it's been massively reinforced.
So I'm going to leave you with this final thought today. With expanding margins, a booming AI pipeline, and trading at roughly 19 times forward earnings, which is a really notable discount compared to its high-flying tech peers, did the market fundamentally misprice this tech giant? Our deep dive definitely suggests the post-earnings drop was a severe overreaction, basically masking a company that is quietly building the essential plumbing for the future of artificial intelligence. Thanks for joining me for this explainer. Keep learning, and always look beneath the surface.